Many parts of our financial lives involve crossing quiet thresholds, points we don't always notice at the time, but which shape outcomes further down the line. Pensions are no different. When someone passes away, the rules that apply aren't dramatic or mysterious, but they are dependent on a few key markers such as age, nominations, and choices made years earlier. Because these thresholds are so understated, people often carry assumptions that don't quite fit how the system actually works. The age of 75, in particular, creates a shift in tax treatment that can influence how much of a pension reaches the next generation. It's a detail with real consequences, even though most people don't think about it until the circumstances force the issue. Today, we are joined by Joe Wellman, Chartered Financial Planner at Quilter Cheviot, who will help us understand what actually happens to pensions on death, why the age 75 threshold matters so much, and why pensions can be one of the most effective vehicles for passing on wealth when handled correctly. Hi, Joe. Thanks for joining us.
Hi, good morning. Thank
Good
you very
morning.
much for inviting me.
Oh, it's an absolute pleasure. Thank you for joining. When people start thinking about their financial legacy, how do you encourage them to see pensions within that longer time frame?
I think it probably all starts by having a good plan. So I think with clients, it is important that we earmark when do we need money and how do we structure it. So pensions is always one of those things that's probably last in line. And that was predominantly because of the legislation. Clearly, that is changing, and that will make quite a big difference to planning. But the thoughts have always been that you structure your plan with having provision first with your least amount of taxable accounts, whether it's your ISAs, whether it's your core accounts, which is CGT applicable, clearly lower than income tax. And then the last point of call essentially was your pensions. I think that has probably shifted a lot for people, and we'll have to adjust and reevaluate in come April 2027 and just see how we adjust the planning for most of our clients.
When someone dies then with a pension in place, what are the first sort of steps that occur before any benefits can be passed on to the beneficiaries?
I think it's very important as a starting point. Clients need to know that they need to put beneficiaries on their pensions. You need to complete your expression of wishes, because with the pension, the setup and the structure of it is within a trust setup. So although you could have a will in place, it doesn't necessarily mean that the pension will follow that order. So it's important that they put their expressions of wishes and add beneficiaries to the pension, because then the trustees at least have an idea of where the pension will go to. You can dispute it. Of course, you can if there's someone who's financially dependent on the person who passed away. And then comes into play the difference between the pre-75 legislation and the post-75 legislation.
What assumptions do people sort of commonly bring to pension inheritance, and how do those assumptions sort of influence the decisions they make?
I think for the majority of our clients, the assumption's always been that the pension has been used as a legacy plan. So it's always been that that's your backstop. If we need extra money or if anything happens, we can fall into that, because we're quite fortunate that the clients that we tend to deal with has got a lot of wealth, and it's distributed through various pots. And the pension was always left as a last resort, as a legacy plan. And that's probably also one of the biggest reasons why the legislation changes has come in.
And if we think about those different sort of pots or vehicles, in what ways do pensions behave differently from other assets when we think about transferring wealth between the generations?
So one nice thing about pensions is the fact of how it's treated in accumulation. So if we're looking at, for example, comparing a pension to your normal core account or unwrapped investment. So if you're looking at an unwrapped investment, if you need to rebalance or you need to adjust the portfolio, you're going to trigger a capital gains tax charge. And the nice thing about pensions is if they're in accumulation, your investment manager can rebalance, restructure, buy and sell assets within the pension with no tax implication. And a lot of the time, people tend to forget that you've got gross roll up in a pension. So you can continue to accumulate and accumulate, and there's no tax implications until the point that you start accessing those pension funds.
And we've obviously touched on the sort of age 75 threshold. How do you explain the significance of that threshold to people encountering those rules for the first time?
So the 75 rule is very important, and it will make it so most of my clients will clearly have a plan in place up till to 75, and at that point it's likely that you'll readjust of what your intentions are and how you would leave that to your legacies. Um, Without being frank, like we none of us know when we're going to pass away. It's a lot more lucrative dying pre-75 than it is post-75. But unfortunately, we're all trying to live as long as we possibly can. And it's quite sad to think from a tax perspective that it's so much better for people to die earlier. But essentially what happens is pre-75, your benefits are tax-free to the beneficiaries that receive them. There is a slight caveat with that you've got what's called the lump sum death benefit allowance. So that is the maximum lump sum that your beneficiaries can take without incurring a tax charge pre-75. And the current threshold is 1,073,100. However, there's a slight little niche or bypass with that legislation. If your pension fund is worth substantially more at the point of death and you die prior to 75, you can actually put the pension into drawdown, which will allow you to bypass the measurement against the lump sum death benefit allowance, which means that after that point, withdrawals can be made to any amount tax free. So I don't think that's probably well explained in a lot of the legislation and a lot of the things available on the internet. But it's quite important that clients need to know that you can actually, if your pension provider can facilitate a drawdown facility, you can get around having to pay any taxes pre-75. So post-75, what happens is that your pension becomes taxable in the hands of the beneficiary. So unfortunately, at that point, if you withdraw benefits as the beneficiary of a pension, you will be taxed at your marginal income rate as the beneficiary. Again, that's a difficult one, and it's not one that you can get around, unfortunately. And with the new legislation coming in, it's quite important that clients understand the impact of the new legislation, especially when they've put a plan in place of how they would like to beneficiarize their pensions. So I've seen a client recently who his sole aim was to leave the pension to his two children. The problem that he had is that although he had a very nice defined benefit scheme that would pay him and then his surviving spouse a fixed amount of income, which was sufficient to sustain their standard of living, his pension is worth £2 million. And leaving that to your children, especially under the new legislation, and also the fact that he's over 75, will mean that there's a tax charge. And now the problem that you start having is liquidity. So people think on first death, okay, great, it's gonna go to my kids, and my wife's gonna have enough money. But now you need to pay a tax charge on that pension. Where does the money come from to pay it? Because if she's gonna, as the surviving spouse, needs to use her funds to pay it, then you're not leaving her liquidity that she actually has sufficient money to continue to survive on. So it's small things that you just need to factor in when you're making these decisions. Because yes, you can leave it to your kids, but if they now, under new legislation, need to use the pension to pay the IHT charge or the inheritance tax charge, they're also going to pay income tax at their marginal rate, which then doesn't make it quite as efficient as a planning strategy.
And you mentioned a couple of different pensions there. Do different pensions respond differently to the age 75 threshold? And if so, what are those differences like?
So with the age 75, they all become taxable. So the only, like, if you think about, is the defined benefit schemes. But the defined benefit schemes, essentially, you don't actually own a pot of money. It's not your pot of money. You own an entitlement to accrual rate that gives you an income provision, and that income is clearly taxable depending on what your marginal rates are.
Obviously, there's a lot of useful information there. There's a lot of things that people could be doing. What would be your top two tips for people to consider as they either sort of prepare for crossing that age 75 threshold or they are crossing it?
I think it's very important just to have a good discussion as a family and as a wider family about, one, who's the beneficiaries, where does it go to, and what provides the big net outcome to the estate, and then also ensuring that there's liquidity to make sure that if a tax charge is due, that there's actually funds available to pay it. One thing that I would also note as a good practice, or something that I think is quite important for clients to consider as they are accumulating and they are reaching retirement age. So we have a lot of clients that are purely focused. Say, for example, it's husband and wife, and they purely focused on topping up the pension of the higher additional rate taxpayer because, yes, ultimately you get the most tax relief. But then you get to the point that you're retiring, and then you're in a position that you want to have withdrawals of 150,000 pounds worth of income. Okay, now you only have a part where the husband, for example, I'm just taking the normal narrative as such, got the biggest part. Now you're drawing an income of 100 to 150,000, so you're going to pay a higher or additional rate tax because you didn't try and balance it in the way up. So I always say to my clients, it's a balancing act between making sure that we at least have two spouses that's got some kind of pension so that we can optimize income withdrawals in retirement. But clearly, we also want to make sure that we get the most relief going in. But you can't always take the highest amount of relief and then leave the other spouse with no pension, because then you're not going to use their personal allowance or their basic rate at the point of retirement.
And it's another one of those things where it sounds like the earlier you think about it, the better, right?
Absolutely. But that's with all planning, essentially. Longevity just makes everything a hell of a lot easier because you can use compound interest and you essentially have to save a lot less. So good planning, have a good structure, and adjust your planning as your circumstances change is probably the best that you can do for any client.
Wonderful. Joe, thank you so much. That was really helpful. Really appreciate you taking the time out.
Pleasure. Thank you very much for having me.